As the debate over if or when we might hit a recession continues, my next guest says look no further than one data point for the answer: continuing claims. They're up 22% year on year, flashing a signal only seen during or just prior to recessions. I'm pleased to be joined now by Michael Darda, chief economist and market strategist at Roth, MKM, and the dog. I always have to mention. Mike, good to see you again. Welcome.
Good to see you. Thanks for having me.
You know, the data is so consistent that I don't really understand why the market doesn't care. Any thoughts about that?
Yeah, I mean, it could just be that, people have been talking about a downturn for a long time. I think we all have some sense of fatigue, even myself. But it's hard to escape the message of some of these numbers. Jobless claims are a leading indicator, but a much more near-term leading indicator. The yield curve, monetary growth, residential real estate, leading indicators, but long horizon indicators. Jobless claims tend to inflect just right before recessions, usually with a heads up of only a couple months on average, if that. And what we're seeing from continuing claims, as you noted, up 22.1% year over year in the weekly data set, totally unprecedented outside of recessions or just prior to a recession taking place.
Is it possible that we just got artificially low because of the pandemic and all of the extra cash and the unheard of strength of the labor market? So in other words, is it not a real starting point to start from where I think the best we got was like last fall. So should we instead start from something, quote unquote, more realistic, like, I don't know, January?
Well, recessions just aren't about levels, but rates have changed. So I don't think so. But that will be the argument. I mean, if you listen to what the bull case is, it's simply that, the data got distorted by the pandemic. Everything is fine. The labor market is going to stay tight. So it won't really be a recession, or if it happens, it'll be so mild the market might not even notice. I think that's a bit of wishful thinking, unfortunately. I mean, I think we'd all hope we could just simply sail through this without a downturn. But boy, you're really making an aggressive bet against a lot of indicators that have historically been quite helpful in warning about a potential downturn. Inverted Treasury yield curve, a collapse in money supply growth, which, by the way, probably is going to be ongoing. If you're watching the commercial bank deposit data every week, it's collapsing. We're down almost $1 trillion in nominal terms from year-ago levels. Wow. Literally unprecedented. And you have the Fed that, is pursuing this inverted yield curve policy, which, if anything, is going to intensify if futures markets are correct. They're going to go for another rate hike. And behind the scenes, they're continuing to do QT, quantitative tightening. So the reserves base that all deposits and broad money are built on is continuing to go south. And so in that environment, do you really want to make aggressive bets for soft landings or no landings in a situation where the equity market is at least priced for that, if not something more? And I would say just, you're really not getting paid in these risk markets to make that bet at this point. So it makes sense, in my view, to play it a bit closer to the vest, more defensively in here.